Trading futures and options on futures involves substantial risk of loss and is not suitable for all traders and investors. Oftentimes in futures trading, you have a high combination of leverage and volatility. And although this could be an equation for opportunity, it's also an equation for risk. So be careful. Only fund your futures trading account with risk capital. My personal definition of risk capital is money I could afford to lose, doesn't change my lifestyle, or overly stress me out. As human beings, we make bad decisions when we're under stress, so be in a good spot. Remember, micro contracts could be friends. Take it easy on the day trade margins. You get plenty of leverage without maxing out on those day trade margins on a regular basis. We'll be taking a look at a real-time simulated live NinjaTrader trading platform today, and none of this should be construed as trade or investment advice. Past performance not indicative of future results. Good morning, everybody. Welcome to See the Futures. My name is Jim Cagnino with NinjaTrader. It is February 21st, 2024. Appreciate everybody being here with me today at See the Futures. We have a very special guest today. Joining us is Sterling Smith, AgroSampro North America. Sterling, good morning.
Good morning, and how is everything with you this morning?
Everything is good, but it sounds like you are having it a little better. You mentioned a 70-degree day yesterday.
We have been unseasonably warm. It was 70 degrees here today, and was able to take the car out with the top down. In fact, we are seeing very much unseasonably warm temperatures. I'm going to be able to play golf this weekend. I'm going to be able to play golf next weekend, and we're seeing highs generally in the 50s, 60s, and 70s for the next 2 weeks, where normally those should be in the 30s and 40s. And also, we're not getting any precipitation. So we are beginning to set the stage for something here a little bit.
Yeah, I was going to say, I would envision you with the top down driving around inspecting the fields in the Midwest.
Actually, I usually do that with the windows rolled up and do that in the SUV because the gravel roads are not exactly user friendly. Normally, this time of year, you kind of expect to see some ice and snow. And we had a big cold dip in January. We came out of that very quickly, and we have been seeing unseasonably warm temperatures really for the last week and a half. And we're expected to see this all the way at least into early March. By the time we get to early March, winter is basically cooked. So it is unusually. Go ahead.
Well, you mentioned maybe we're setting the stage for something, right? What are the possibilities there?
Well, the possibilities. One, we're starting out. Things are unusually dry. We're still in a major drought, and if you look at the eastern third of Nebraska, stretching all the way into Iowa, there's still very persistent drought conditions. We had a little uptick in moisture, but the forecast for the next 2 weeks has absolutely no precipitation in it. We're coming in with a very, very dry moisture situation. So one of the first cues that we may be having a drought year is early planting. If we don't get any rain very, very soon and in noticeable amounts, guys are going to be able to get their crops in as early as they can get away with, where they can avoid a freeze. So we could see normal planting, or we might see things a week and a half, 2 weeks early, which is good if we get precipitation down the road. If the weather pattern holds, and we saw this in 2012, crops went in very early. Oh, it's going to rain, it's going to rain. We got to May and it wasn't raining, and that changed everything. So this is, well, it's definitely better than it being 12 below zero and snow everywhere. This is getting a little worrisome here.
But there should be an advantage, right? If for an early planting and rain, that should result in more yield, right?
That would result in a much bigger crop. And we had the USDA Outlook report last week, which gave the first estimates for the new crop. And they guessed yields at a bin busting 181 bushels an acre, which would be an all-time record. And last year we saw 177.3, which was actually really pretty good. And with this, they cut corn acres a little bit, but still raised ending stocks. Now, if we get early planting, there's a couple things that go on with this. One, farmers plant soybeans earlier and earlier every year because they find that that extends and improves yields. But again, we're going to be much more dependent on that late season, on that mid season and center season weather to get the precipitation, because right now we don't have that soil moisture for a big part of the central corn belt.
Okay, so if I'm a farmer, I have to decide how much risk I want to take with the early planting. And it's
Exactly.
based on the best weather forecast I could get.
Right. It's based on when the last freeze night is going to be. You don't want that seed in the ground and having experienced, a week of freezing temperatures. That is bad news. You have to tear it out and replant it. One day or two you can get by with. So if we do see these extended warming temperatures, the ground gets easier to work. The ground is not frozen. It was frozen for about 4 days and it is completely thawed out. That creates some risk that if temperatures nosedive, but if we start, knocking highs around 75, 80 degrees in April, your chances of getting a freeze drop to a very low order of probability.
Okay, but if unfortunate things happen and you get the freeze, and you already planted, is the crop ruined, or just it's not going to be as fruitful?
Well, the seeds are ruined, so you go back in and you replant it, which adds
I
to
see.
expense. You can get some insurance claims on that, and that is a risk in planting a little too early. And as long as it stays dry, people probably won't be too aggressive. So you'll have everyone watching the weather and seeing, as long as we can keep, temperatures above 35 degrees overnight for a week straight, you're probably good to go.
Okay. So I have a similar problem down here. I'm in Charleston area, South Carolina, and it doesn't have to be 32 degrees for frost to form, right? It's,
Right.
It's around 35, 36 degrees here. And I know it's different when the seed's in the ground, but that's when I, bring out the frost cloth and cover everything up.
Right. And usually it takes a little time before you get emergence, before you start getting that green fuzz. So your main risk for early planting is the seeds being damaged in the ground. That's the real big risk. Unless you see
Got
a
it.
late
Okay.
frost or something like that, which we have had zero threat of the last 4 years.
Got it. So, okay. So right now, let's take a look at some of the commodity charts and think about what happens to price when these hopefully favorable conditions pop in. And I have a corn chart up right now. We can go to wheat, we can go to soybeans, meal, whatever you want.
Well, let's start with corn here. And your chart looks a little interesting there. Is that a daily chart or is that a weekly chart?
This is a daily chart, but I have I have not it's not back adjusted. So when there's a rollover kind of scenario, it will show gaps and stuff like that.
Okay, because my chart looks a little bit different right now. I've got corn at 427 and it's down, no, about 5.5. We're scraping along what potentially, and I'm going to use that word potentially, maybe we're trying to grapple with the bottom here. We have an enormous fund short position. In fact, we're 12,000 contracts short of an all-time record fund short. So, how much they're willing to press the downside here, that may come into question. And since we are sitting just above life contract lows, we can be pretty safe in assuming that all of these positions are profitable. If this market begins to smell a little bit of risk in here, and that we could have from a drought problem to a planting problem to maybe these big yield ideas the USDA came out with in the Outlook conference, that comes under some risk. We do have the potential here to maybe change the temperature of this market a little bit. I'm not saying we're going to get a big screaming rally, but the first step into getting a rally with this grain market is going to be stopping the hemorrhaging, and we may be getting close to that point. So as we begin to develop more risk, we're going to be looking more at new crop, which is December, as opposed to looking at these old crop contracts, which are kind of known. And as the funds begin to roll those shorts, March is coming up on first notice day. So they're going to be rolling out of March. They will be rolling some of this into May. Maybe they don't roll quite as much, and that could create a situation where we could get some trading opportunities and a little bit of a bounce here. So I think while I've been generally sitting in the camp that risks are tilted heavily to the downside, I think the downside risks are becoming less and less, and profit potential on the downside becoming smaller and smaller. Obviously, all of the easy money's been made, and we could see this market get a little bit nervous, and that could change the temperature of things a little bit.
Would there be any conditions that would continue this downward trend in prices and not have a bounce?
If we were to see, we get out here another couple of weeks, we get into, say, second, third week in March, saw a couple of good soaking rains relieving those drought conditions in Nebraska and Iowa. That would be a problem. That would not in any way delay planting in any way, shape, or form. You would have moisture coming into thawed out ground, so it would have plenty of opportunity to sink in and improve that subsoil moisture profile. That would be a risk to the downside. By the same token, if we do not see that, that is beginning to create additional risk to the upside.
Got it. So tracking 427.5 right now, that's, the expectations probably more to the upside than the downside.
Yes, I think the scales have finally slipped, gone from tilted to the downside to now even with upside risks being higher than downside potential.
Okay, it makes sense. It makes sense for sure. You want to toggle to wheat or soybeans?
Let's go to soybeans.
Now I probably rolled over maybe too soon. I'm in May right now on my chart, but here's what my May chart looks like.
Yeah, so let me punch up my May beans here.
So it's a daily. I have a daily continuous that's not back adjusted.
Okay, that's why your chart probably looks different from mine, because mine is just the chart with no adjustments made. And here too, we saw some better price action yesterday, and today we're finding a little bit of pressure. So we did see a little bit of fund covering across all three markets as open interest did drop a little bit yesterday. Now, as long as we don't fall back and hit those fresh lows, the soybeans can be a lot more nervous about things. Right now, we have harvest pressure from Brazil. Brazil's harvest is 32% completed, and we have fresh beans in the market. So there is not a big rush to come in here and buy soybeans right at the moment. But again, the drought situation, the same story with corn. Where they grow the corn is where they also grow the soybeans, and we do have a big growing area that is most definitely coming into the growing season at risk. And that's something, again, we have a near record short in the soybean market, and funds will be aggressive about covering, and this can produce a very interesting rally, depending kind of on how the weather plays out. And if you want to see a good example of how this can work, we should take a look at May cotton.
So hang on a sec, though. I want to go back and ask you about open interest, because you just mentioned it, and a lot of traders and people really don't think about that as a gauge of what's happening. You just mentioned open interest is decreasing, suggesting that the funds are getting out. Is that right?
What that indicates is short covering. Open interest is something that's very important in commodity markets, and you should look at it just as much as you look at a COT report or anything else. When you see prices rise and open interest drop, that is a sign that there's short covering, because the market has gotten smaller, so there is aggressive buying going on to shrink the market that pushes prices up. The thing to remember about short covering rallies is they often do not have a long lifespan. However, when you see open interest rise and markets rise, that's an expanding market. That means you're bringing fresh buyers into the market. That is a much healthier rally situation, and vice versa. If you see prices decline and open interest go up, that's a sign of near-term selling. If you see prices decline and open interest rise along with it, that is a sign, of a market expanding to the downside. So open interest is very important, especially when we have a market that maybe has been in a trend and that trend has been extended, and that trend may be getting a little ripe.
I see. So this is something we should look at every day, especially in the commodity markets.
Especially in the commodity markets, especially, for example, if we look at wheat yesterday, big outsized move. Open interest dropped about 25,000, which is clearly indicative of some short covering going on. Absolutely the signs sign that funds were cutting their position. You can see we had a very good day in the wheat markets yesterday. The wheat markets also, Kansas City and Minneapolis in particular, have enormous fund shorts. The Minneapolis market in particular is much, much smaller than Chicago, and Kansas City is smaller than Chicago but bigger than Minneapolis. Funds decide to come in here and cover. They don't have as much maneuvering room, and that again can really affect and really drive prices. So, something to be aware of. Very often, it's the Minneapolis and the Kansas City that actually push the Chicago wheat along. You think about it like this: Minneapolis wheat is the best wheat. That's the Rolls Royce wheat. Kansas City wheat is the Cadillac wheat. Chicago wheat is the Chevy of wheat. It's not. It's a lower. It's a lower quality wheat. Wheat is blended and milled into flour, but it is a lower quality, and that's why you always see its price being noticeably lower than the other two.
So when I go to the store and I buy my wholesome bread,
Mm-hmm.
which wheat am I eating?
You're getting a combination of Kansas City and Minneapolis with maybe a little bit of Chicago wheat put in there. If you buy whole wheat bread, I've got a trivia question for you here. How many
All right.
loaves of bread can you get out of one bushel of good quality winter wheat? Take a guess. And we're talking,
How many loaves?
we're talking a 50-pound bushel here.
I'm going to say a 50-pound bushel. I'm going to say a lot. I mean, 300.
No, not 300, but you can get 100.
Okay.
So think about this when you're buying the bread right now. Just to make it easy, we'll call it $6 a bushel. In that loaf of bread, there is 6 cents worth of wheat. So if the price of wheat were to double, you would now have 12 cents of wheat in that loaf of bread, which, given the price of a loaf of bread, tells you where the costs in the bread are obviously other places. There was an article in the Wall Street Journal this morning talking about food as a percentage of American budgets, and it hasn't been this high in 30 years. Some of that is knock-on effects from supply chain. Some of it is coming off of a period of fairly elevated commodity prices. But a lot of this, everything in the food, from fast food to the farmhand to the grocery store to the processing plant, is fairly labor intensive. You can't get people right now to work in these packing plants, so that has driven labor costs through the roof. And a lot of this just can't be automated. You can't really automate meat cutting. If they could do that, they would have done it the first chance they would have. There's just not room for much automation there. And that is the reason why food inflation has been so noticeable, is this essential worker part of the food chain has seen their wages go up, and meaningfully. And that is something that is going to keep food inflation, not necessarily inflation, but food prices are going to remain elevated. And that is really not going to change that much.
So, well, you said so much that I have so many things floating through my mind right now on that one. But so knowing that, I'm going to have a different point of view when I see the next, CPI numbers as an example.
Yes.
Right. So they talk about X food and energy and core.
Mm-hmm.
That could be deceiving in this case.
It can be. And CPI numbers, you have to remember, CPI numbers are a control group to measure against themselves. It's kind of like, when you see that EPA sticker on the car and tells you how many miles per gallon you're going to get, it says in big letters for comparison purposes only. Real world results will be different. And this is sort of the same thing with CPI. CPI is a controlled group, and they look at it so they can measure what's going on within the control group. So yes, some of these numbers are going to be a little bit deceptive. And even if you see food inflation tick up, yeah, that's going to be a problem overall for food prices. But by the same token, they say, well, food and energy and housing don't matter. Well, the vast majority of households in this country, their biggest expenses are housing, food, and energy. I mean, if your household is not having those expenses being your highest ones, you're a household that's doing very, very well.
Yeah, no, no doubt about it, no doubt about it. And we kind of neglect it, right? Because we talk a lot about some of the other markets, the equity markets, the treasury markets, the currency markets, and the idea of core, not thinking about food and energy, or at least food, is it's easy not to think about it, right?
Right.
But once you start thinking about it, it affects everything.
Yeah, because there is a knock-on effect. Americans as a whole still spend the smallest percentage of their income on food of any country on earth. In some cases, by an enormous measure. But again, it depends where you are in the food chain. If you're, a household with not as many means, that spending on food and energy, and particularly food, is going to mean you're not going to be spending it somewhere else, and that has
Yeah, there's
knock-on
nothing
effects.
left.
Yeah, exactly. That has knock-on effects to other parts of the economy, and it begins to create a crowding out effect, especially when you combine that with how much housing prices have gone up since 2019.
Yeah. So, all right, we talked about wheat a little bit. I'm going to pull up a soybean chart really quick if I can. Let's let this data percolate here for a minute. And a similar kind of pattern here. Everything's looking a little bit negative here in this.
Yeah,
I have May on my screen.
Yeah, and this is old crop, and most likely the bullishness, if we start to get seeing some planting risk and things of that sort, it'll find its way into the November futures, which we know how many May soybeans we're going to have, and we got plenty. We are not going to be running out. But as we move on into the season, South America will get tight on their supplies, their harvest, they'll ship that. So as we move out into the summer, there's a lot more weather risk, and that may help create some upside trading opportunities here. Because where we are right now, and given the fund position, trying to be short could prove to be a more difficult task, simply because the size of that fund position, how much more they're willing to grow it, really is going to create a situation where you may not have as much downward pressure, where all of a sudden you're going to see a universe where we have potential upside risks moving in disruption to production.
Totally makes sense. Speaking of South America, by the way, I'm going to Sao Paulo, Brazil, later this spring.
Okay.
Let's talk about Brazil for a second. What are their exports looking like?
Their exports will most likely be a record. Right now, they're expected to produce 150 million metric tons of soybeans, which, if we go back in time to the year 2000, they produced 20 million tons. They were expected to produce about 162 million tons, but they did have some weather problems and issues, so their crop is going to be a little smaller than expected. Still a monstrous crop. Just if we go back to 2019, they were only producing about 125 million tons of beans. They have introduced pasture land. They have plenty of room down there. They're not chopping up rainforests to do this, but pasture land has been converted into cropland, and the amount that they converted since the beginnings of the trade rankle and the trade war is about the size of the state of Kansas. So that's a lot of new land brought into production. This won't be leaving production. So I would suspect we're going to have some new ideas about uses for soybeans, particularly good for biodiesel. We're seeing better processing here in the U.S. and better meal exports, which is one leg of what we're going to need to do to help keep prices better supported. The other factor in South America is actually Argentina. Argentina has had miserable crop after miserable crop. They're actually going to have a crop that's fairly normal this year, and that help to make up for Brazil's issues. We're going to probably see 10, 12 million tons more production out of Argentina this year. Now, if we see the weather change and we move out of our friend El Nino and move into La Nina, which is what is expected to happen this fall, that creates some problems for South American weather and typically hurts production, particularly in Argentina. So there's some moving parts down the road here that can help lift these prices.
Okay. We'll see. It just seems like, we have a whole bunch of exports maybe coming our way, and there's going to be ample supply.
Oh,
Maybe.
we are well supplied currently. However, I think the USDA's Outlook conference raised ending stocks for both corn and soybeans up to extremely high levels, and these are predicated on ideas that we're going to see nearly perfect production. We haven't been able to do that for the last 4 or 5 years, and we're coming into this growing season with plenty of risks. So, again, maybe this report that we got last week that put in those lows, maybe we've reached peak bad news.
Got it. All right. Well, we're on short time right now. So is there any other particular market or
Yeah,
something you want to
let's
talk
talk
about?
about.
I don't have. Go ahead.
Yeah, May cotton.
I don't have the softs up on my screen today, but let's talk about cotton anyway.
Cotton has seen a precipitous rally. Funds have come in over the last 7 weeks. They were net short. They're now net long, and they bought about 67,000 contracts. So they were net short about 7,000, net long about 60,000 now. That has produced an extremely stout rally that hit the wall yesterday, but I'm seeing follow through buying in here. So a lot of fund interest here in cotton. I think we have some global ideas that we're going to see a better economy, and that has created a very interesting market here because cotton will compete with acres with soybeans. So that's something already where we're seeing some sands begin to shift. And I think it was a relief to farmers everywhere to see cotton prices go up to let them know that, yes, prices just don't go down right now, that things can change.
So on like cotton and some of the softs, how important is the commitment of traders data? Is it too delayed or is it good stuff?
Oh, no, it is extremely valuable, and you should definitely be tracking that. And again, we want to look for anything that's out of bounds. Funds too short, funds too long. Okay, for example, for cotton, they've been in here buying. They bought 67,000 contracts. They have this fresh long. How cotton really performs over the next 3 or 4 days may speak volumes to their willingness to hold on to this position because the position grew very rapidly and prices moved up, not as much as you'd think with that much buying. So we have a situation where we may be able to create some volatility, but if we can get a little push, some good fundamental news, that's something that could certainly work to drive this market higher. So,
well, all right. Well, we will next time I'll have softs up for you. We'll be able to cover new crop, old crop, and some of the softs in more detail.
Yeah.
We are up against time though. I appreciate you being here with us.
Oh, anytime. And we should talk about the superstar of all commodities, cocoa, at some point.
Okay, well, we'll save that one for the next time. I know we've been talking about scheduling, and hopefully we're going to have you on a bunch more in the next couple of months. So we have a lot of opportunities for that. And I'll tell the audience, if you want to, I can put you in touch with Sterling. Just send us an email to learn, LEARN, at NinjaTrader.com, or you could follow Sterling on LinkedIn. I think is the way to go, right?
LinkedIn
Sterling?
is the easiest way to get a hold of me. Yeah.
Yeah, for sure. Easily found. Agro Sampro, Sterling Smith, thank you very much for being here.
Thank you.
All right, everybody, thanks for joining us to see the futures. Appreciate you. And I do want to remind everybody, please be safe out there. Be good to each other. See you soon.